Hi everyone, my name's Simon Fee. I am the founder of FeeFi. It's a fractional CFO business based in Dubai. I've lived here and lived in Dubai for 11 years. I worked in Emirates, worked in McLaren's, a loss adjusting business. Moved here in 2014 and from the UK, and realised almost straight away that it was a very, very different place to work as as an accountant, as a finance professional, for a variety of reasons. I think if you're watching this video, you'll kind of get where I'm coming from, more from just general work environment than just being an accountant. I went self-employed last year and pretty much had the rug pulled from under my feet, intentionally. By that, I mean that I really did see the how small businesses operate in the UAE. It was a massive shock to me. I lived quite a sheltered existence working in my two previous businesses. I've been doing this now for 12 months. I've worked with quite a few clients over that time, and I've worked with some good ones, I've worked with some bad ones. But what I am certainly seeing is that people and founders, freelancers, small business owners really do need or would like some kind of basic financial advice, and that's what I'm going to give you as part of this presentation today. So yeah, my name's Simon, CIMA-qualified in 2007 from Bolton near Manchester in the UK. These are the companies that I've worked for in that time period. So FeeFi is obviously in the middle, but you can see around this now you've got, aviation. I've worked for two airlines, one in Dubai, one in Leeds in the UK. TransUnion in Leeds is financial services. Even worked for a rail casting manufacturer in Leeds, which was an experience. Utilities, loss adjusting, which is McLaren's. I've also left my Ravers in Dubai logo in here as well. I'm not just a finance guy, but I'm also a DJ and an event promoter. That's one of the reasons that made me go self-employed. I realised that I wanted to try and break away from corporate life for a bit, see how it goes. Yeah, so that's my background. As you can see, I've worked in a lot of different industries, gained quite a lot of experience working in those industries, both in the UAE and the UK. Right, what I'm going to go through on in this presentation is really just talking about the building up of this big ball. What you'll see is the small oval at the bottom, which is businesses starting out in the UAE. So I'm going to kind of explain company formation and registration of companies, primarily on the tax front. What happens from that registration is then the ball really does start to roll from a regulatory perspective. So then start to talk about VAT and corporation tax, which are mandatory. Once you move beyond those, you'll start to realize that finance isn't just about filing your tax returns. It's about getting some kind of level of insight into your business. So I'm going to walk you through the finance basics. Finance basics are normally produced by accountants, so I'm going to explain what they are and the different kind of roles within the accountancy space. As you're all founders, you obviously have a kind of a plan for your business. For whatever reason, you've set up this business. So I'm kind of trying to kind of outline to you what founder finance is, what you guys should be doing, and what you should be thinking about in the future. And then something I've dealt with more on the corporate side, the company side, rather than on the self-employed side. But quite a lot of businesses here are either seeking investment or want to be, seek investment from outside or even sell their business. So I'm going to talk around what investment is and how you need to prepare your business for that. Okay, so what is finance for SMEs? So, like I said before, on paper, it's just bookkeeping and filing your tax returns, and being audited. Every business in the UAE should be audited. That's what the central bank rules are. In practice, not many businesses are audited. So what businesses tend to do is just have a bookkeeper for tax returns. In practice, as a founder, all you're looking to do is survive. Ultimately, so make sure you have enough cash to pay your bills, make sure you have enough cash to invest in your business, grow your sales, ultimately grow your profit. and to do that in a sustainable way. So, making decisions that mean when you get your second client or your 10th client or your 100th client, they're scalable. Businesses are scalable, and it doesn't, create double the amount of work or 100 times the work. So good finance should help you to work out if you're actually making any cash, make better choices faster, and just really for you to think about your business rather than thinking about the finance part of your business, chasing clients for money, filing your VAT returns, dealing with your auditors. They're the kind of basic functions that I see accountants serve in the UAE. Okay, so I'm going to go through these kind of elements now. I'm going to go through the dry one to start with, the tax one, because obviously, that's what everybody really thinks accountants do in the UAE, and it is obviously a really important part of what we all do. So it's like, okay, so what is tax in the UAE? You're going to see two types of tax. So I'm going to start with corporation tax to start, because that's what the first tax that you will have to register for. So corporation tax is a tax on profits. That profits I'm going to come on to later on, but it just means the excess income that you make from your business. So your invoices less your purchases is your profit. What you need to do as a business owner is to register with the FTA, the Federal Tax Authority, within the first 90 days of registering your company. It's really important you do that, otherwise you'll get fined. Or at the moment, I think there's a bit of an amnesty on that, but up to now there was a fine associated with that. You have to file annually. Even if you're not making a profit. So what I tend to see from time to time in the UAE is that some businesses think that certain rules don't apply to them. So one common one is that because they're not making a profit, then they don't have to comply with corporation tax. You'll see on the big red sticker on the right hand side, it's mandatory for all companies. So both the corporation tax and VAT are mandatory for all UAE companies, and that you've got to file each of these regardless of if you pay tax or not. So that's corp tax. That is currently most companies are filing theirs at the moment. So I'm working with a client whose year end is in December 2024. So their auditors, their bookkeepers are preparing their tax filing from Jan to December 24, and they're following the rules, the corporation tax rules, which state which revenues and which costs they include in their calculation of what their tax profit will be. And then most of those companies will then file that in September 2025. If they make a profit, then they pay the tax. If they don't make a profit, then you can carry that tax asset forward into future years. So you'll say, I made a loss of 200,000. That's, making numbers up now, but say 10,000 dirhams. That's what it would have been as an asset. So you would say, right, okay, you don't have to pay it now because you don't have the money. But when you do start to pay profits, you can offset that against the future profit. Getting into a little bit of a technical part of it there, but yeah, they're the two circumstances that will arise out of the first corporation tax return. They will then occur every year after that. So that's corp tax. Like I say, that's very new. Second type of tax is VAT. So VAT has been in place since January 2018. This is a slightly different way of registering for VAT than it is for corporation tax. So you don't have to register immediately. What happens is that there are these thresholds that you have to meet in order to register. Basically, you add up your invoices from when you start to trade. And then in any 12-month period, you add up your invoices, and if they are above 187,500 dirhams, then you can voluntarily register for VAT. You don't have to because it's voluntary, but you can do that. You can do it soon. You don't have to do it at one point. You can do it sooner. This is common in most countries. If your taxable supplies reach 375,000 dirhams in any 12-month rolling period, then it's compulsory that you have to register for VAT. Very similar to corp tax, you go to the FTA, you submit the usual set of documents: passport, Emirates ID, articles of association, and then you are registered for VAT. Okay, so what does that mean? It means that when you get your VAT number, you are by law, you have a liability to the government to pay VAT on any supplies going forward. So in the past, you might have raised an invoice for 100 dirhams with no VAT on it. When you have your tax number in place and you are fully registered, by law, you've got to pay 5% of the 100, so 105 dirhams. The 5 dirhams of that, you have to pay that to the government. And what they're doing is they are taxing your supply of that sale. So it's a tax for you making money from that sale, or making profit out of that sale, or value. That's what the VAT stands for. What you can also do at the same time is any invoices that you receive, any purchases that follow the VAT laws. So it's the same laws that you will have to follow. You have to put your VAT number on the invoice. You have to show the VAT in net, VAT and gross terms. You can then claim the VAT from your bill. So the 5 dirhams that I've talked about before, let's say that you had a 50 dirham purchase, so that's two and a half dirhams. You can then reduce your tax bill by 2.5 dirhams. So it's 5 out, 2.5 in. 5 less 2.5 is 2.5, and that's what you pay to the government. The reason that you do it like this is because you are VAT registered. You're no longer what's called a VAT end user. As a consumer, as a human being in the UAE and in most other countries, you are always the end user because you're not VAT registered. The entire point of VAT is that the end user pays all the VAT. The companies that are VAT registered are not end users, and therefore don't have to pay all the VAT, and that's why you have this kind of liability or payment of VAT from one side, but then you're able to claim the VAT that you pay on the inside, and the net amount is what you pay to the government. I'm talking in very, very, very basic terms here, obviously, but this is what VAT accountants do in the UAE and around the world, and they should make these rules clear to you. Each business is different, so I've just explained this in very simple terms. It's far more complicated in certain businesses. Different businesses have completely different models. Some will be supplying to outside customers outside of the UAE. Some will be supplying within the UAE. There'll be different types of product that they're selling. All these follow slightly different VAT rules. And it's the responsibility for your tax advisor to make you aware of these rules, understand what is your business, and then make sure that you comply with those. But ultimately, you as a business owner, you are liable for your tax bills. So your tax advisors will always make you sign a letter that kind of, make you liable for the bill. But that is the way it is, and that's how it is around the world. So make sure that you're kind of aware of this up to a point, but certainly speak to a tax advisor and make sure you can find a half decent one. So that's the dry bit out of the way. Now to the exciting bit. So the basics of finance, really. So I'm going to start with what's finance for you. So basics. We're going to talk through 3 financial statements. So the first the 3 financial statements are there to show to yourself and to show to outside parties the financial health of your business. So the first financial statement is the profit and loss, which is now known as the income statement. The profit and loss statement isn't just for us. It tells the business owner how much money they're making. You've got revenue and you've got costs. So your revenue, and sorry, I've just kind of paused then because I thought I'd added some extra bits on this, but I haven't. So the revenues are a sum of everything that you sell as a business. So they are normally your contracts. You raise an invoice because you've agreed a contract with a client, and in businesses, the sum of their invoices is their revenue. Now, I'm keeping it very, very straightforward on this presentation. It isn't as straightforward as that. Um, Let me give you an example. You have one client, you have one a client that sells the same service for the same amount of money to a client. The first client will want to be billed in 12 monthly installments of 100 dirhams. The same client wants all of that to be billed all up front. So 100 dirhams times 12 is 1200 dirhams. So you'll have, in one case, 12 invoices of 100. And in the second case, you'll have one invoice of 1200. Okay, those are the same amount, the same contract period, but the billing frequency is different, and this really matters in a profit and loss account, because the first example, it's kind of spread over a time period. In the second example, there's a lot of revenue in month 1, and there's no revenue in months 2 to 12. So it can give you very different ideas about how the business is operating. So that's revenue, mostly a sum of invoices, to keep it simple for now. Costs are costs. So you pay your purchases, you send out purchase orders, you receive purchase invoices, you have contracts in place. They're the costs. There can also be costs that you haven't yet paid for. So end of service benefit is a common non-cash cost in a profit and loss. You think about your employees in your business. If you've got some long-standing employees, your P&L should account for the cost of you employing that employee for each month that they're under contract with you. Their end of service benefit bill gets bigger for each month that they're in the business, and an accountant will account for those costs in each month. To show the activity of the business. If they showed it as a cash item, then the cost will be at the very end. And if you've got somebody, say, that's been in your business, say, 10 years, and you have a substantial end of service benefit payout at the end of the 10 years, then you would want to see the cost of that employment throughout that 10 years, and not free of charge effectively for 9 years and 11 months. And then a huge cost in the final month of their contract. So these, I'm talking about two concepts here called cash accounting, which is just straight from the bank, and accrual accounting, which is activity based. Most business owners, it certainly doesn't apply to them on the cost side. It does on the revenue side, and their bookkeepers should be sort of looking into this and asking questions to make sure their books are correct. And I personally think there might be some issues that come out of this in September when people start to file their accounts, and some issues may come out of that. That's a feeling that I've got from the experience that I've had recently. Anyway, so there your revenue, there your costs. What's profit? What's loss? So straightforward enough. Your revenue is higher than your costs. Great, you're making a profit. You're adding value to your business, which is great. If your costs are higher than your revenue, so startups mostly have costs higher than the revenue because they're paying out for subscriptions or networking days or whatever, and they've not got any clients, so they'll be making losses. But then obviously with a view to making revenue and making profit further off down the line. More established businesses, loss-making businesses, you really do need your accountants involved in this, because it's they will give you the insight to work out where the costs are high, where remedial action needs to take place. The common one in this is removing staff out of a business, because that's normally the highest cost for a business. But it's not quite as straightforward as that. Moving out of office, whatever. There's all different types of measures you can do there. Sometimes a loss, is a strategic choice of a business. They may have a contract in place where they're intentionally making a loss because they want to keep that client and they want to grow that type of product in the long term. So sometimes this is, it's not the business doesn't want to do this, but they've consciously made that decision to make the loss because of the strategic long-term benefit to the business. So it's not always a terrible situation making a loss, although almost all companies don't want to make a loss. Third one is break even. It's very rare you see break even. You'll normally get something close to break even, and that just means that the two numbers are equaled out. What you'll also tend to find in businesses is that you'll make profit in one month and loss in another month, demonstrating the cyclical nature of your business. So you'll have good months, you'll have bad months. You'll have months where you make a lot of sales, or you'll provide a lot of services to your clients. Like say January time when people come back from the holidays, September, October time when people come back from the holidays, quiet times, Ramadan, August is quiet. You'll tend to see that this kind of goes up and down when you're kind of looking at your numbers in a level of detail. So that's the income statement. Second financial statement is called the balance sheet. You'll hear this misrepresented on the news all the time. So have you ever wondered where your money went? Even when you're making a profit, your balance sheet will tell you that. It represents your business's health check. I and a lot of other accountants would say that the balance sheet is the first thing that they look at when they're sent a set of financials. The reason for that is because it's forward looking. It shows you what you own, what you owe, and what you have to pay to your owner. So it represents stuff that's going to happen in the future, rather than a profit and loss represents what has happened in the past. The profit and loss is very important because it shows how much value you are making within a time period. But what you could have is a lot of liabilities and not enough profit to pay off your liabilities, or not enough cash, sorry, to pay off your liabilities. I'll come on to that in a second. So the balance sheet is really important because you can see the liabilities and the assets, what the company owns, what it owes. So I've worked a lot in the past 10 years on assets. So converting your stock, so your products that you've bought from a wholesaler and they're sat in your warehouse, they're not making you any money. You've got to sell them to somebody through a contract, raise an invoice to them, generate cash. Cash is the physical embodiment of profit, effectively, but getting the cash is easier said than done. You can also work in professional services where the stock is actually what's called work in progress. So your guys are working hard with clients to provide services to the client, but they haven't yet paid you for those services. And it's really important that you kind of convert that to cash because you're obviously paying people's salaries and things. So assets, very important. Liabilities, as important. What you owe. So, what are your bills that you need to pay out to your suppliers? So, if you don't have enough cash, you withhold payments to your suppliers, just like clients withhold money to you if they can't afford to pay you. You may or may not have loans with banks or with, third parties, related parties, etc. And then I've already talked about taxes, but obviously taxes are very important, and it's important that all those liabilities are on your balance sheet, in addition to the non-cash costs that I referred to earlier. So end of service benefit is as a liability because you owe that to your employee when they leave. And again, very important liabilities. It demonstrates the cash outflows that will be funded by the assets in the business. Final one is equity. So this is a little bit harder to get your head around. If you think of equity, this is what is owed to the owner. So the owner of the business is actually separate to the business. The balance sheet is a report for the legal entity, and the owner is just an owner of the business. And what the equity says is, we owe you money for profits that we have made in the past. So if you've got a business that's generating a lot of profits, and at the end of each year you're generating, say, 100,000 dirhams of profit every year, then in theory you owe all of that money back to the owner because it's the owner owns the business. The owner may choose to use that for other purposes, so financing, for buying capital assets, all kinds of stuff. But the equity is there to show, you still owe them this money. It also shows to you who you owe the money to as a split. So you might not have a single sole owner. You might have multiple owners with different rights on dividends, depending on the shares that have been issued by the business. The equity statement will show all that in the balance sheet, or it's certainly a high level view of that. That's the balance sheet. Third one is cash flow statement. Basically, the cash flow statement is a way of showing you how you went for your profit to your money leaving, money coming in or going out. So here's the uncomfortable truth: you can still be profitable and still run out of money. So the cash flow statement bridges the gap between your profit or loss and the money in your bank account. So, for example, a business may have raised 300k of invoices in a year, but they've only collected 250k, which is not a bad year, to be honest. Not certainly not in UAE terms. It's pretty good. So your 300,000 will be revenue, but and that is what is in your income statement. The uncollected 50,000 dirhams will be still on your balance sheet because it's owed to you as a business. So that's kind of forward looking. What the cash flow statement shows is the fact that you've received 250k from those invoices. It also shows the outflows of cash on the cost side. So talked before about salaries, they're paid out, but end of service benefit is not paid out. So it's kind of making a distinction in your income statement between what you have physically paid out and what you haven't paid out. And various other things like financing cash. You might have taken on loans. You may have paid off loans. Those are not shown in your P&L because they're owed. They're not part of your profit and loss. They just fund your business as a liability. So this is a really important statement. This shows, like I say, it bridges the gap between the P&L and the balance sheet, but it also shows how businesses are funding their cash flows. So if they have poor working capital management, so their clients are not paying them quickly enough, or their stock isn't converting to invoices quickly enough, they need to fund that in another way. So they may take on debt, they may delay payments to vendors, all kinds of things. And this statement shows you how they do that. So yeah, just kind of showing you a flow of the cash is there. I'm sure you're kind of familiar with this. You're sending invoices, you're paying payments, you're paying your salaries, you're buying equipment, and then that becomes your net cash. They're all different types of profit and loss and balance sheet items that all will appear on your cash flow statements. So yeah, they're the three financial statements. You should really be seeing these every year, more than every year, to be honest with you. They're not just a regulatory tool. They're there to tell you about how your business is operating, and they're a really useful feedback loop to see where you can make changes to your business, good and bad, to improve the value. So I'll come on to that shortly, but they're the three statements. Right, now I'm going to talk about accountants. Why am I going to talk about them? Because you need us to do these statements, or you need somebody in a finance role or an accounting role to do that. Accountants tend to be lumped into one big group. I liken it to when a finance person walks into HR in a company, and all the accountant thinks that all the HR people have the same job. That's similar to what I'm saying now. Everybody thinks accountants have the same job. They certainly don't. There are different types. The three types that you're going to come into contact with in the UAE are here. So most founders think they're covered because they've hired a bookkeeper, and that's what the first one is here. So the bookkeeper or the accountant, their main focus is to make sure that you have accurate records and that you are complying with the laws. They will be involved either on a monthly, quarterly, or annual basis, depending on how much you pay. You can pay not a lot of money. I've seen 50 dirhams a month for one vendor. I would be paying at least 2,000 dirhams a year for mine, just to get the absolute basic rudimentary information. But the less you pay, probably the less frequent you'll see your statements. What statements are they providing? They're filing your taxes primarily. They could send you a P&L, but most of these businesses just entirely focus on doing tax filings. So they'll provide to you a tax calculation for your corporation tax and for your VAT, and then they'll get you to sign it off, and you may or may not ask questions about it. It may or may not take a very long time for you to get that information, but that's ultimately what you're paying them to do. I have found a lot of issues with bookkeepers in the 12 months I've been self-employed. I actually had more prior to that, but I was in a multinational, and I had I had the luxury of picking some half decent auditors. They weren't that good, but yeah, typical issues are they don't understand the context of your business. Why would they? They're remote. They're not in your business regularly. They don't provide any insight or any analysis. That's not why they're there, really. You can pay them more money to do that, but that's not really why you've appointed them. Um, your business is either already complicated or will become complicated, mostly because of people, clients, vendors. Things just become more complicated, and in complexity brings finance challenges, bookkeeping challenges. Certainly, when your business gets larger, so you start to generate more revenue, then the accounting rules become more sophisticated. You have to follow them, and your bookkeepers need to do that. But in order for them to do that, they need to understand the complexity of your business. These guys are in a race to the bottom. It's a very much a cost competitive market. So you get what you pay for. It's as simple as that. I've mostly worked with bookkeepers that are not providing nowhere near the basic level of service. I work with two or three bookkeeping businesses that are very good for Dubai. They ask questions, they manage their time, they at least have a basic understanding of your business. This is the absolute bare minimum that you need from a bookkeeper or an accountant. Okay, so that's type number one. They're the ones you're definitely going to deal with. Second type is an auditor. So auditor provides an audit report. So, like I say, some companies have audit reports, some do not. Despite the laws stating, I think all businesses should have, or maybe there's a threshold, but there is a central bank directive stating that everybody should be audited. What tends to happen is that you'll either have an owner who is conscientious and understands the value in finance and wants to be compliant and gets an audit report produced. A more common case is that a business needs an audit report to be produced so they can renew their free zone license. And what tends to happen is the free zone will have a deal with a local audit firm that has to do the audit report, which yeah, you can have an opinion on that, whatever. But you'll still need it in order to get your license. It may or may not be a good audit, but you still need it. Some companies have a tendency to just loan you their letterhead and put all your financials in a on the letterhead and stamp and sign it, and then that's fine. Now that's trade license done. They're not the kind of auditors you should be wanting to work with. Auditors are there as a third party, an independent review of the financial accuracy of your business and highlighting any areas where you need to improve your financial statements so that you comply. But also, it's there ultimately for people to see the value in your business. If you want to sell your business, it's absolutely essential that you get audited financials. Otherwise, you will either lack credibility in selling your business, or people will drive down the price of your business because it's not been audited. So it's really important that you're audited just from an investment perspective. What do they tell you? They just tell you if it's right or not. It's what's called a true and fair view statement. So they say these accounts are correct and they comply with the laws. If they don't comply, they'll provide what's called audit opinions. So they'll say this is right, but there's this bit that's wrong, or that needs to be looked at, and is materially wrong and needs to change. You want to try and avoid them as best as you can because they're a red flag to investors and to readers of the audit report. Typical issues is, like I said before, just audit quality. If advice is inconsistent, you have good product and bad product. It's really important that you get this done though. It adds value on investments for sure. I've talked about that. Yeah, so please be audited, please. It's one of the first things I ask when I'm speaking to clients. Final accountant is me, really. I'm one of these people. So we are like kind of senior guys in finance. So we don't do the bookkeeping, we don't do the auditing, but we provide financial strategy, we provide business insight, and we provide the owners or the managers with decision support. So you'll see this when they wheel the finance guys in to sign off stuff at work. They don't want to sign anything off, or some companies don't want to sign anything off unless the finance guys have seen it. They may or may not understand it, and but it just gives them that level of comfort that there's had this financial oversight on that. When do you need us? Well, you need us. You don't need us all the time, unless you've got a growing large business and decisions are being made on a daily basis. As a founder, as a small business owner, you just need us from time to time. So when you're planning for the next year or the next 5 years, when you're starting and planning, when something doesn't feel right and you can't work out why, and you need somebody who's been there and done that before. I could list a long list of situations like this where retainer contracts, clients don't know how much is being utilized in the retainer. Their cost of acquisition of paid social media is very high, and they want to understand how they can get a better return on investment. It might just be a simple case of them not understanding their finance staff or their auditors. So a senior finance person can be the bridge between the owner and the auditors and the bookkeepers, and be the managers of those guys rather than being the business, because the senior guys have been there and done that before, and if they've got enough UAE experience, they can deal with them and warts and all. So what you get is hopefully clear, actionable advice to run your business now and in the future. We are quite expensive. We've sat all our exams. We get paid better than the other two normally. So you want them when you need them. So if you need a CFO in your business, where maybe you've got $10,000 in investment or $50,000 in investment, you need the credibility of a finance director or a CFO, managing those funds, giving reassurances to the investors, providing information to the investors, and just guiding the business, then you absolutely need a senior person in your business. Maybe you don't have that investment, your business is growing. I always say that I make more money out of clients that have problems. But so that's good for me as a self-employed fractional CFO. But I always prefer to work with companies at the starting phase, because you can just put them in the right direction. So I could just bill them a day rate, like one day for me. I can set them on the way, and at least they've got this kind of grounded advice there, rather than just kind of looking at it in the dark. So fractional CFOs in Dubai, I know quite a lot of them. They have a pretty good network as well, so you can, consult them on company formation, legal, cybersecurity, all kinds of HR, all kinds of stuff. Cost depends on the part-time, full-time, fractional, and in most cases they do add value. They've been around the block quite a long time. They know how things are, and you should, at the appropriate time that you need one, please reach out to me or one of my colleagues. Right, so that's accountants. I'm going to pick up the pace a bit now. So UAE founder finance. So this is why you're watching this video. You just spent 38 of me drawing on about finance. Why are you on this? Why are you watching this video? What do you need to know? Okay, so what every UAE founder should know. First thing is, and you've already picked up on this already, please hire a good bookkeeper. Right, somebody that gives you clean, timely, and useful numbers. So they're not just there for a VAT return. They're there to give you information about your business and to give it to you in a timely fashion. So whether that could be a bookkeeper that's outsourced. It could be a receptionist that's taking on some of the finance work, and then the finance work becomes too big, so they then move away from reception and become the finance person, and then they get a team, whatever that may be. You might get a finance director within that, but those guys need to give you clean, timely numbers. Clean means that it complies, so everything's backed up with a document. it's compliant, it's given to you in a reasonable time frame. These are absolute, like, they're not even basics, they're below basics, they're absolutely essential. Second part is that you need a cloud-based accounting system. So this is a online software where you log all of your financial transactions, and that produces the three financial statements that I've shown you, in addition to VAT filings and fixed asset registers and other things. Why do you need a cloud-based accounting system? So you can see it on your phone, so you can access it wherever you need to. Your bookkeepers will be in another location. You can all access this. It's really important so you can see your numbers. You don't have to wait for people to send you the numbers. It's a good way of keeping tabs on your bookkeepers to see what they're doing. And a simple check to know if they're doing things quickly enough is look at the bank balance in your finance system. Make sure it's as close to your actual bank balance as it is. If it isn't, then there's work to be done from your bookkeepers to reconcile it. A lot of businesses kind of steer clear of the cloud-based accounting system and just say my bookkeepers dealt with it. I would advise against that. And this is your information. They are just providing this to you. When they leave your business, the cloud-based system will be handed over to you. So it's really important that you get access to this and look at the numbers and see if they make sense. Spreadsheets are inevitable, but try to steer clear of spreadsheets. Try and keep it in an accounting system. It will make your life way easier down the line. There are many examples of these systems: QuickBooks, Zoho, Xero, loads of them. Each person has their own favorites. They're all very similar. They all have different levels of functionality, but they're all cloud-based accounting systems, and you definitely need one. Third thing everybody should know is that you should always ask questions and demand answers from your bookkeepers and from your finance people. If you don't understand your numbers, then it's fine for you to say so. If you don't understand the follow-up question, then keep asking again until they give you what you need. If they don't give you what you need, then replace them with somebody else. It's really important that you do that. You wouldn't expect a supplier of like a subcontractor that you appoint on a project to give you substandard work on a project. So it's the same for your finance team. For your finance outsourced bookkeeper. You're the boss. You deserve the clarity. Ask questions. The fourth part, I've kind of touched on it already. You need to keep accurate records. So you need to make sure that absolutely every transaction is backed up with a soft copy, invoice, receipt, contract, everything. You need to keep accurate records for 7 years for corporation. I think it's 7 years for VAT. So every VAT transaction that you put on your VAT filing, you need to back that up with a document. And for 5 years, every transaction in your corporation tax, you need to keep on record. Why do you need that? It's because when the government audit you at some point, you will need to demonstrate that the number on that filing is backed up with something that's tangible. So an invoice to a client, they will want to see the invoice. They may want to see the contract. They may want to see the product that you supplied to the client. It sample checks the numbers that have been submitted. This is what I've been involved in quite a lot of audits over the 20 years, and especially in Saudi Arabia, I've had the rubber glove treatment in Saudi Arabia. They will go to town on it. I'm not saying your business will do that. We're in early stages of corp tax, but it's really, really, really important that you keep your records. Keep them in the cloud-based system. That's what I would always recommend. That's the easiest place to store them. It's accessible to everybody, and then it's all matched to each transaction. Whereas if you save it somewhere else in a Google Drive folder or in a SharePoint folder, you've got to manually link the transaction in the cloud system to the document. Okay, moving on. So once your business has survived or just pre-startup and it's been registered, what else should you need to know? So in your costs, it's absolutely essential that you separate your business and personal spending. So to the more financially savvy people, this is a bit of a no-brainer, but to people who've not been involved in this much in the past, some people see their companies as bank accounts for the owners. It's really important that you keep them separate. I'm not saying that you don't transact your personal spend through the business, but it isn't recognized as a cost to the business. If it was recognized as a cost to your business, that would reduce your profit, which would reduce your corporation tax bill. If you recognize that as a cost to your business and you claimed VAT on it, it would reduce your VAT bill. All these taxes are all based on the fact that the numbers in your system are wholly and exclusively for your business and not for anybody else. So if you're putting your gym membership through your salary costs, and that's not, just justified because it's meaning that all your salary costs together add up to about 1.5 million dirhams a year, then that's that's not a business cost. It's everything being put into it. So you absolutely need to make sure they're separate. If you do pay stuff through your company bank account that are for you, then it's just a loan that's being paid off to the director. So that goes to your balance sheet, but it doesn't go to your P&L. Absolutely essential. Doesn't go to your P&L. Doesn't go to your VAT filing. Set up feedback loops. So this is not just in finance. This is just a general business good habit to fall into. The reason why I say it on here is that tracking and reviewing your business historically, having points where you go back and look at a point in time, last year, last month, look at your P&L, look at your overheads, look at your overheads over the last 6 months. These are all really good feedback loops to see how your business is operating. As your business grows in size, you lose control of your business to an extent. And it's really important to keep feedback loops in place, like financial reporting, so that you can kind of hit the brakes, have a look, or even your finance person can have a look at it, raise actions with the employees, raise actions with you as the owner or the manager. It's really important. Spots errors, spots fraud. It can improve your performance. It's really essential that you have feedback loops. I use them a lot. Final one is on this page is in the UAE, in the GCC, there are good companies and there are bad companies. I'd say there's a lot more bad companies than there are good companies. What do I mean by that? I mean that they just don't comply with the law. And going back to what I said before about, some people thinking the laws don't apply to them. There's a lot of non-compliance on VAT, or there certainly was over the last couple of years. And vendors of companies, they just expect their clients to accept their bad habits. Most of them don't even know that they've got a bad habit, but it's really important that you don't pick up those bad habits. So if somebody sends you something and asks you to pay an invoice and it's a statement of account, they ask you to pay something and it's a purchase order or a sales order, push it back to them. Say, I'm not paying you till you send me an invoice. That's how you pay things in the UAE. I'm not supplying you services without a contract. I know this is a hard and fast rule. Sometimes this might not be possible, but there needs to be the exception. Please don't pick up the habits of your stakeholders, because that it can get you in trouble, and it can get you in trouble because it's just a bigger mess to sort out in the future when you get somebody like me that comes into your business, sees the bad habits, and then asks the business to change them as soon as possible. Okay, so that's my kind of basic advice for starting up and for growing on the financial side. Once you've kind of gone beyond startup, what you need to start thinking about how to grow your business, which involves planning. So it's really important that you have a cash flow forecast in place. So I talked before about a cash flow statement. That's backward looking. A cash flow forecast is forward looking. So it looks at what's in your finance system and your balance sheet and says, right, when is that going to get paid? It's you put into your cash flow statement things that you've not yet signed up to, like your second year of your rent, increases to your rent, increases to your salaries, bonuses, all kinds of stuff. It's really important that you have this in place. A lot of businesses have very irregular cash flows. So I've got one client who bills 50% of his clients up front, and effectively uses all that cash to fund the purchase of an appliance that they're going to sell to the client. That means his bank account is, it's high because he's got the payments in, then it's lower because he's paid out for the appliances, but then he'll have all these extra costs for fitting the appliance. There'll be extra invoices. The cash goes up and down. There are nasty surprises. You have to delay payments. It's really essential as part of you surviving, that you have a cash flow forecast. In the more longer term, it shows to a potential investor that you've got a handle on your cash, and that you are, demonstrating that you are delivering the profit into your bank account. Second thing, longer term, is that your bookkeeper, your accountant, your receptionist, your inexperienced finance manager, keep looking at the bookkeeping setup, keep looking at the finance setup. Think about when you need to go and speak to a CFO. Think about when you need to go and speak to a recruiter. Think about when you need to employ somebody to do this in-house permanently. It's really important. This is where you start to move away from the finance operations from day to day, and it's really important that you get a decent person in to do that. You can get some decent people for fairly cheap salaries. You can also get a lot of very bad people for cheap salaries. But ultimately, what you need in your business is a gatekeeper, somebody that can push back on your business, and most importantly, someone can tell you when something's going wrong. Absolutely essential of those three things. And, certainly when you have someone in-house, you expect them to do that. Next is just building a plan. So, you sat here today, you look around your office, you've got 5 people in your office. Right, what's this office going to look like next year? What are my clients going to look like next year? Which clients am I going to keep? Which ones are at risk of not renewing their contract? Which are new products or clients that I need to look at? And what cost do I need to spend to acquire those clients? All kinds of stuff, all the stuff that's in your head. This is what a financial strategy is. It's a month by month P&L budget. It's a balance sheet and cash flow forecast going forward. What that does is it solidifies your plan that you stick to. You can change it down the line, but it's just a point in time where you have a plan. It's a good way of indicating to investors how you're going to grow value in the business. That's external. Internally, it's really important because if you choose to, sorry, it's a bit noisy out there. If you want to get buy-in from your business, a budget is a really good way of shared ownership of a business's finances. You might not want to show all your budget, but I tend to find that companies that share budgets with employees, they get bought in with the business. They get bought in with sales, cost reduction. It changes the way that they deal with stakeholders. It's really important you have that medium to long-term plan. Sorry if it's a bit noisy outside, but I live next to a very, very noisy building site in JVC, which is not ideal for doing things like this. Yeah, I'll skip on from that because I already discussed that. Right, so final part of the circle is the investment side. So I work with a CFO collective called Momentum DNA. We look at companies that are on their investment journey from startup to growth. They might have growth pains. They might not be able to get the value out of the business that they want, but ultimately they want investment. So they either want business money into their business, or ultimately they want to sell their business. So this is where senior finance guys can add a lot of value to that process. How do you seek investment? So the first thing that you do is you've got to make sure that your numbers are right. So everything I've just been talking about before, your numbers being right. Investors don't just want a good story, sell them a good idea. They want sound numbers backing it up. They want to see your receipts. So they want, if they're looking for funding, and I talked about this before, it's essential that it's clear and consistent financial history that's audited, compliant. It makes sense. Your sales are growing. Your gross margin is either flat or growing, or if it goes up and down, fluctuates. You've got a clear message as to why that has happened. You've got backup and analysis within your numbers, so you can demonstrate to them who your biggest clients are, who your most profitable clients are. Just a clear history of a business looking in the past. Also your plan, so showing how you've got this well thought through financial plan. So it's not just about producing a income statement. You've got to have realistic revenue projections, what I talked about before, who you're going to be selling to, which clients are going to not renew and expire, which are the new ones that are going to come in, and what types of product development and market development are you going to do, what are the costs associated to that. Also looking at your cash flow forecast and looking at what's called your burn rate and your cash runway. So your burn rate is how much more money you're spending than you're taking in cash in revenue. Startups tend to spend more than they acquire, or tend to spend more than they sell. So investors look at the cash burn rate to see, how quickly the money is leaving the business, how much money is being spent by the owners, how much is being spent by pre-seed, all the different types of investors. It's just, they just want, obviously they want to see the burn rate reduce and then ultimately drive cash inflows into the business on a net basis. That's what the plan shows there. Cash runway is just how much time you've got until your cash runs out. So I've got a cash runway in my business. I keep a record of all the clients and contracts that I've got in place, and when that runs out, how long is it going to last? And how many months have I got left until I run out of money? That's what a cash runway is. Again, investors are really keen to see that. But slide decks and investment is non-financial as well. So you've got to prove that you can execute it. So it's not just about the numbers. Have you got the right people in the business who've got proven track record of delivering and executing? What's the market potential and what's the competitive advantage? So using any kind of as is position audit or positions analysis, like five forces and SWOT analysis and things like that. They want to know about your legal position and if you've got any intellectual property like patents, what your rights are there. Do you have those? If you've got them, then that's the value in the business. That's exclusive right for you to sell those products. If you don't have IP, then anybody can sell your products legally. And then just general compliance. So a lot to take in there. Some financial, some non-financial. Very briefly, kind of just go through the different types of investment. These are not all the different types of investment rounds. These are just early stage because I'm just talking to you as founders. So you've effectively got 4 stages here, and it's from the point where you sat at your couch at night with your laptop thinking that you're going to start a business and that you need 100,000 dirhams to get a trade license and get a website going and get some brand strategy, and you have some money in your bank account. That's pre-seed money. You might ask some family and friends to chip in. This is pre-seed capital. You're just selling them an idea. You might have some kind of idea and financials in place, but ultimately you just need that money to start the business, start to trade, and deliver what's known as a minimum viable product. So MVP. This is used quite a lot. So this is just where you kind of reduce down your services down to just something small enough that proves that you can deliver it in the medium to long term, like a proof of concept. So I'm working with a client that's delivering a music venue app that tells the user where decent music events are around cities around the world. In the long term, this app will be rolled out globally in most of the continents around the world. So they've agreed to do an MVP just focusing on a few cities around the world, prove it works there, and they need the pre-seed capital to do that. Then they have proved it, or maybe they need more. They've kind of got a small genesis of an idea or a small business, but they need some chunky money. So they'll need a business development manager to start going out there and pitching the business separate to the founders. They probably won't need a finance person here, but they just need people to scale the business more. So, and they need money to do that. So, you can't pay, you got to pay someone's salary for a few months before they start to generate sales. You're paying for research and development. So IT guys, developers, coders, you're paying their salary to develop the product, develop the application, like SaaS software that is common there. So, again, you're selling an idea, you're selling some base level financials to, people that you probably don't know, but people who are out there with available capital to invest in businesses like yours. You might be giving away some kind of equity That's what's known as seed capital. Then you get to various series A, B, C, D. I've only ever dealt with A and B, but this is where you start to give away like equity in your business, and you're starting to scale the business more. You're starting maybe to deal with institutional investors like venture capitalists, family offices, venture capital companies, and this is effectively just there to provide more capital to your business. It's also to provide expertise and route to market, where these investors have been there and done that before. You might be working with an associated client in like a associated company in your industry, or it might just be somebody that's proved that they're applying their skills and expertise, but just on a different industry and a different product, and they want equity for that. Technology is another common example. This is where your financials, as you go down through these rounds, your financials are becoming more sophisticated. When you start to get to seed, definitely Series A, you start to go through what's called due diligence, where the potential investors will send in analysts, financial analysts, accountants, bookkeepers, CFOs to interrogate your books, produce, get access to what's called a data room, where they see your financial information and they ask questions about your business to better understand the business and to appraise the investment. My experience in companies has been Series A and Series B, where employees have gained share options through the businesses. I've been involved in private equity sales of the businesses that I've been in to private equity firms, obviously, and they've, in one case, I was actually involved with the due diligence guys when I was in Leeds. It's one of the hardest things I've ever been through. Very, very, very complicated studies. These guys are super clever guys. They're paid a lot of money to do this. Some owners don't want to do this. It's just on the investors' request, really. You can get some investors that invest money in your business without wanting any financial information, sometimes without audited information. They may run into issues further down the line when they want to divest and they want to sell their business, and then they didn't do their right due diligence and then they bought the business. That can happen. It all depends on the investor and on the owner, but I would be doing myself out of a job. You need to do this to a degree if you want investment, because it's a bit like a service log in a car. If you don't have a service history, then somebody's either not going to buy your car or they're going to want a significant discount on purchasing your car. And in a much more complicated way, this is what financial due diligence is, and all the stuff that I've talked about before. Right, so yeah, that's what we've covered. Getting the basics right, all that stuff. I'm not going to go through that. That's what we've covered quite a lot in the last hour and 2 minutes. I'm just going to say just a few useful links that you can go to. So I've got a website, fifi.ae. That's my business, Fifi. If you want to look at some of my blogs, it goes into more in-depth detail into some of the things I've talked about. So company formation, being audited. I've got a 101 on financial terms, and go into more detail to some of what those terms are. I post on LinkedIn a few times a week where I kind of talk through stuff like this, or I'll just talk about topical things that are going on in the news, in the financial news, or just in the news in general. Yeah, and they're my contact details. If any of this has resonated with you and you want to talk to me in more detail, I'm available each Friday. You can go to my, for a face-to-face chat or an online chat. So I can better understand your business and I can provide you some kind of basic advice. If you want to go further and for me to go and look in your business and start to go through a discovery project, or start to provide a scope of work to, bring your business up to the levels that I've talked about today, go to my website, book in a meeting through my calendar link, and we can discuss then. Or send me a WhatsApp message. It's up to you. All right. Thanks for watching and see you soon.